I like to look at the world in terms of risks because asset prices don't reflect the world as it is today. It reflects the collective assessment of what might happen in the future. And if your view differs from that, you have an investment opportunity. And then I overlay that with my assessment of what people do, and it's really our desire to put meaning into the market. And maybe let me start with that with regard to precious metals in particular. We do have the folks who invest because of their concern about the purchasing power of the dollar. We have the diversification investor, we have the speculator, and we have central banks. And that's kind of the sort of investors, and then I'm oversimplifying that I look at. And if I just go through these different buckets, on the gold bug, the purchasing power investor, the key thing about that investor is that sort of investor has moved from the fringe in a global market setting more towards mainstream. It's not like everybody is concerned about the dollar plunging tomorrow, but because the gold market is fairly small, there can be an outsized impact on these small moves. The diversification investor has always been there. The key difference is that an increasing number of investors doesn't believe bonds give them the sort of diversification they've been hoping for. And so we've got more investors from that front. The speculators, those old enough know that gold used to be the nirvana for speculators. And then meme stocks came along, SPACs, cryptocurrencies. Well, as of a few months ago, the speculators are back. They increase volatility. And then, of course, we got the central banks, including, if I can group them into that, some treasury funds of some stable coins. And they're not very price sensitive. The key thing here about the central banks in particular is that ever since we weaponized the dollar, we've seen an increased central bank buying abroad. And again, central banks, it's not like they put all their reserves into gold, but they're a marginal beneficiary of that. And I think without kind of ranting on here for forever, the weaponization of the dollar changed the dynamics of the price of gold. It used to be gold is not correlated to anything really in the long run. It doesn't mean, but it shifts in and out. These correlations are morphing. But the one thing gold historically competes with is long-term cash. If cash preserves its purchasing power, why would you want to hold this brick, this barbaric relic? Well, you would want to hold it if cash is losing purchasing power. And there used to be a correlation between the price of gold and the TIPS yield, a long-term inflation expectations. And that has broken down ever since we started weaponizing the dollar a few years ago. And that is kind of was the beginning of a wave, and that we are currently in a phase of that.
So let's start with the weaponization of the dollar. And, first of all, I mean, we've been using sanctions for a long time. And that's not new. So when you say a couple of years recently, are we talking with Russia, Ukraine? Are we talking what was it, extra fertile ground that made this time different? I mean, why? And we've seen sanctions before. So how exactly has this caused such a huge drift in the dollar or in the gold price?
There's a difference when you put a sanction on trade of oil, which may not be effective, or some other goods. It's very different when you start confiscating accounts, when you freeze assets of foreign governments. That's very, very different. And Ukraine and Russia, the conflict there, of course, comes to mind. I'm not saying that those things are necessarily bad, but it changes. The world is run on incentives. And so you're incentivizing the bad guys from our perspective to reallocate the money. And so that has a huge impact. But since you mentioned sanctions, the other part I do think that's very relevant in the more recent time is tariffs. People are all glued into the flow of goods and forget to think about the counterpart of that, the flow of currency. When you disrupt trade, you are impeding the flow of currency, and you're putting sand into this machinery we call exorbitant privilege, because the money doesn't flow back in as easily, which means our deficits will need to be financed more domestically, putting upward pressure on long-term yields. And a side effect is that we put increased pressure on the Federal Reserve to lower rates, because doing the right thing, which is to cut our spending, is politically less attractive.
So you have sanctions, you have tariffs, we have weaponization of the dollar. We've been talking, we've been seeing BRICS getting momentum. I don't know what your view is on if you think BRICS is going to gain traction, but I wanted to ask you if you see the world de-dollarizing, or as the current administration would try to push for re-dollarization. Do you see it kind of gaining back traction, or do you see countries continuing to move away?
Uh, One of the privileges of being a guest is I can answer the question I want to answer, not the question you're asking. So let me answer a slightly different question. Because
Okay.
the reason I want to reframe it just a little bit, because
Yeah.
the way you started it, is saying, oh, the BRICS countries are benefiting or this or that. When to just follow on this sand being thrown into this machinery called exorbitant privilege. First of all, it's not like a light switch that's going on and off. These are relative changes, gradual processes. But the important part here is that people say, oh my God, the dollar cannot lose its status as a reserve currency because there's no alternative. And you're saying, oh, maybe BRICS is an alternative. Well, my point is there does not need to be an alternative. What we see is an increased fragmentation. We see a deglobalization. And
Hmm.
what that means is that the global machinery becomes less efficient. We can still do global commerce. And by all
Hmm.
means, if you have a foreign country abuse its power, I'm not
Yeah.
saying you shouldn't necessarily have tariffs or anything like that, but it does have implications. There are real implications for how this global machinery is working. And so what we have, and then to just layer that on top of it, we have, and it's all related to it, increased nationalist economic policy, not just in the US. China has always had it. You have it more in Europe. They're spending over $1 trillion on defense and whatnot. These are all inefficient ways of running a global economy. It kind of goes against the Adam Smith idea of the invisible hand, because suddenly
Hmm.
you have actors trying to push for winners and losers. And by all means, the winners may well win, but the net result is that everything becomes more expensive. You need to throw more money at your political ideas to make them happen. And so there will be, of course, you can differentiate of which countries benefit and which ones not. The US, of course, being a comparatively closed economy, can quote unquote get away with these things more easily than other countries that really suffer when they're all dependent on exporting to the US. But ultimately, global growth suffers in this process. It makes it more expensive. And then the other thing, of course, is that no major country in the world these days cares about deficits too much. And so this is all it's both the political left and right, right? If you care about
Yeah.
deficits, you fix entitlements. And we have aging populations everywhere. It's a strong voting bloc. And so these are all drivers why precious metals have been doing so well, because it's an increasing number of people that's saying, well, what do we do in this sort of environment? Now, of course, you can invest in the Max 7 and live happily ever after, but if that's not your cup of tea and want to diversify a little bit,
Yeah.
um, precious metals do come up quite regularly.
So you mentioned, first of all, fragmentation. And when I think of fragmentation, I think of two things. One, I wanted to ask you how that's related to bonds not doing so well, uh, or is that related? And then two, in terms of fragmentation, I think of geopolitical tension. It feels like the new normal. Is this likely to be permanent? And are there risks gold investors might be underestimating right now?
So first, with regard to bonds, the main thing is that fragmentation means the universe of buyers is reduced. It used to be that foreigners were a huge participant in buying domestic bonds. With tariffs in particular, that isn't happening as much anymore. And that all else equal provides upward pressure. Now, the other part of the bond market is, of course, the spreads in the bond market of risk assets versus others. That is much less affected by that. The central bank that rescues everybody and anything, and doesn't allow failure anymore. So it seems has more to do with that, and we can talk about that more. Regarding geopolitics, I'm a believer. First of all, historically, I don't like it when there's a crisis and the precious metals jump. The reason I don't like it is because markets get used to crises, and then there's a bump up and it comes back down. What has changed is that I believe we have moved beyond the peaceful era we've had for decades since World War II. And I look at what's happening, be that in Gaza or be that in Ukraine, as
Mhm.
symptoms of a new era. And the side effect of the US having been for decades the global police force was that commerce was facilitated, the shipping routes were safe.